Okay, you guys should be able to hear me. Please have a quick look at, well, actually, let's start this way. Good evening. Welcome to the Hurley Investments Market View Commentary for July 6, 2021. I'm going to start off with some email comments that have come across today. So the first one was, let's get that a little bit bigger, just so my old eyes can see it. What is happening to the 250 or 240 leap long calls? And that was followed up with, why have we lost everything? Which was followed up by, why have we not sold them? And so what people are asking about, in my opinion, is going to be this position. And we have in here some 250s with a $65 cost basis, a $63 cost basis, a $47 cost basis. There's some others that are down here that you don't see. But the short answer is we basically have a $65 to $47 cost basis on 240s and 250s. And there's some that are mixed in here in different positions. But there's like 55 and 54 of them when it comes down to it. So it's rather amazing because I'm going to answer this a couple different ways. And it's going to first start out with the understanding of, and you've heard me say it a million times. So, come on. So, for crying out loud, you think I would have a better understanding of how I want Word to work for me, right? So, my standard answer is to understand what? What am I going to tell you? What have you guys heard me say no more than a million times? My standard answer to what's happening to an individual position is going to be what? There you go. 4 answers just came in all at the same time. And it really comes down to the standard answer is trading / investing is a process. So let's put this process into an understanding again. I'm going to help those of you that are asking me this. When do these calls expire? When do these calls expire? And again, I've got more up there. I've got more down below. But when do these calls expire? There you go, of course. It's like, Kevin, you're underlining them for us, right? When do these calls expire? They expire, these calls expire in January 2023. Cost basis ranges between $67 and as low as 48. And I believe I've got that picture in here as well. Nope. That's not it. So, simple, I understand and I put we because I'm in there as well, right? I understand we have these positions that are losing value. Now, notice I did not say that they're losing money. Someone tell me, why do you think I might say that they're not losing money? I'm just telling you they're losing value. Thank you, Jim. It's an unrealized loss, or more importantly, but not losing money. And it comes down to because I sold short options against the longs, and there's a key word here, after they became profitable. We weren't sure where things were going to go at the beginning of this year. So we sold some short positions to create one of my favorite terms, and we did it over a couple days period, and it's pretty neat just to show you how many 54 contracts and 55 contracts. But we took in a $75, a $76, and a $72 credit by selling these positions short back in February. So, ooh, Russ, I love it. I'm not going to give it away though. So the question is, hey, where are we at here? What's going on? If you notice, all of these short values are more than your cost basis. And as Russ remembers, and Russ has not emailed me, but here I'm going to give away the key, right? Here's the key. You are in a risk-free trade or guaranteed profitable position that has until January 2023. How? Right? And this is just being able to follow up and understanding what you've done. We bought back all of these positions for $7.60, $7.10. The ones we sold here were on the $48 ones. These two we sold here, we're talking about 109 contracts, right? These are on the $65 to $67 ones. If you subtract $7.60, $7.10 from either of these, you're going to be at $69 or $68. you have a risk-free trade. So, number one, you are in that risk-free trade. You're there, you're set, you're good. There's no worries whatsoever. But there's a catch. You have until January 2023, the third Friday, for Baidu to trade above 240 to $250, and anything above those, they're called strike prices. Strike prices or values is more profit. If you have a 240 or 250, anything above those prices is a profit, and you have until January of 2023 for that to happen. So here is the question. So my question back to you, right? Why would you sell a risk-free trade that has 18 months to become profitable? I don't get it. I wouldn't do it. The process requires patience. And patience is a sucky virtue to have to learn. It's ugly. So, question was asked to me, why not dollar cost average? And these are your accounts. So let's think about that. Why not dollar cost average? For me, because it introduces risk into the trade. We are in a risk-free position right now. If I was to dollar cost average or add more into the position, I am creating a risk-free trade into a risk trade. It's not a lot of risk. Right now, if we were to dollar cost average, it's going to be $20. It's going to be $21. I could introduce more contracts, but 54 and 55 total contracts, let's do the math on that. 5,500, right? Times $20.40. Or on my other ones, I've got 5,400, 54 contracts times 100, right? Times $21.75. So roughly, I could introduce a couple $100,000, actually about 250, I think. Let me do some quick math on that. 5,500 times 20.4. 112,000 there. 5,400 times the 21 is going to be closer to about 18. So I could introduce another $230,000 of risk into this $18 million portfolio. But I don't have to. I don't have to introduce that risk for these positions. So because I don't have to introduce that risk to these positions, I'm not looking to do so. There's no reason for me to go through and find all the 250s and, you know, these 250s and, you know, these calls and these calls. And I've got more down below. I mean, we've got 109 contracts of this, right? 109 contracts of stock replacement strategies. There's no reason for me to introduce hundreds of thousands of dollars of more risk into portfolios. We are risk-free, and I'm going to choose to keep this risk-free for as long as we can. So that's the first question that I wanted to get answered. Now the second one was, what the heck is China doing? And what it comes down to is new regulations, right? So it's funny because in the United States, we have literally, and pardon the way I'm going to say this, but we have bitched and moaned about China for forever. They don't use GAAP accounting principles. They don't do this. They don't do that, right? We have complained about China for forever. New regulations, they're going in there, they're being stricter. They're doing everything the U.S. of America, United States of America, has asked them to do for the last 30 years. They're starting to play by the rules. People ask me, Kevin, well, why are they doing it now? Simple answer. Trump tariffs and Biden has not removed them yet. Oh, Trump was such a jerk. Yes, he is a jerk. He's a businessman that is a jerk. Yet whether you like him or not, he's an awfully good businessman. Well, Kevin, there's some tariffs that are coming off on some food. I get it. I totally get it. In fact, I'm pretty sure as I was listening to Fast Money and CNBC and Jim Cramer, I would not own Chinese stocks. I didn't push the Didi, Uber, and China to get you guys into it. I haven't pushed Alibaba that's just taken a huge hit from 300 down to 200. I don't recommend Chinese stocks. I do recommend Baidu because it is transparent. It has 5 revenue streams. It works with Apple, and it has made me millions over the years. It's my most profitable stock I've had since 2000, since I really started. I gotta say, I chuckle. If you've taken an education, retake the classes, and learn from them. The last one, Kevin, do you recommend educations? I don't. I don't recommend educations like I don't recommend Chinese stocks. But Kevin, you recommend Baidu. Yes, I recommend a Chinese stock, but I don't recommend Chinese stocks. There's a difference there. There's one out of thousands that I recommend. In my mind, Baidu is the Apple of China. It's made a ton of money. It's heavily owned by the Chinese big guys over there. It's got 5 huge revenue streams. It owns a third of Alibaba, so I don't know why I have to own Alibaba if I can own it through Baidu. It owns Tencent, it owns IQ. I mean, it is all the way across the board. If you've taken an education, you need to learn from them. Educations, for the most part, are a waste of time. Don't ever blindly follow trade advisories. Period. Notice we haven't put First Solar on yet. No one has First Solar in their accounts. As I was recommending First Solar last Tuesday, I gave a simple comment that said, I'm probably going to wait to see what it does. It was at $94. It's come off of overbought. I would not blindly, period, be putting stuff into a trade advisory. In fact, I'm going to politely pick on a couple people. Someone wants me to go through and tell them how much I've made up on the way down. Someone also on a specific position that requested this for Baidu. Both of you could have figured this out yourselves. Both of you have paid money for an education for one of you and educations by the other one of you. Your education can show you what we're making up on the way down on a $60,000 drop in your account. An education should have taught you how to go back and say, hey, he bought something for $67 to $48. He sold something against it. He bought it back. He made $68 to $69 of profit that creates a risk-free trade here. If you have spent money on education, and I know education suck. No one here has spent as much money as I have had on educations. When you realize they're not using real money, they're teaching theory, their results are full of crap, they're in a paper trading account, they're kind of lying around the edges on what they're really doing. I get it. I understand that. I've been through it, and I've been through it 6 or 7 times. It doesn't mean you can't learn from it, though. If you spent the money on education, for crying out loud, go learn from it. I'm not going to tell you stop using me, but don't hesitate to use yourself. You paid for it, learn from it. You could have figured out pretty easily that you're in a risk-free trade. Kudos to Russ. I've been through education with Russ. In fact, Russ, what were we? We were not safe option strategies. We were spread trade systems in the early 2000s together. Russ, you made my day to say, Kevin, isn't that a risk-free trade? Russ used his education. He calculated where we're at in his portfolio. He said, you know what? I took the education with you back, Kevin, in the early 2000s. Couldn't make me any money, but he learned from it. Spend some time learning from it. Last but not least, how do you add protection? And it's simple. 83% of the time, stocks fall, it's not 20, it's 10% or more during a 6-week period of time. 2 weeks prior to earnings and 4 weeks after. And I want to take credit for this, but I'm pretty sure this was, I'm pretty sure I got this from Fox News, and it might have been the CBOE. So I can't take credit for figuring that out myself. It was from one of those people. So we make sure we have protection on 2 weeks before and through that 4 weeks after earnings. That's what we want to do. If we don't have the protection extended for 4 weeks out, we are prepared to add more protection if needed. If we had to add protection prior to earnings because earnings don't look so good. One of those was Ford today. Ford is 3 weeks out from earnings. We had some protection last month, but we need to add more protection on Ford. We sat today to see if it was going to hold 450, which is a huge pivot point. We did pretty good from 16 down to 1550. I think it was 16. I forget where we were at. Maybe it was 16 to 15. We let it run up. We're back down to that 1450 range. Tomorrow, if Ford, now that we're getting some crossovers, even though it's a week earlier, if Ford drops to 1443, we are going to add 1450 long puts for earnings, and we're probably going to set that order tonight so that it'll trigger. We're going to do a next then order. If Ford trades below 1443, we will trigger an August
in August, 1450 long puts that will go into your accounts, and we're going to keep them for all the people that own Ford. Crossovers, we're going to have crossovers here. We had our crossovers on the MACD weeks ago. We still use level 1 education. We use technical analysis. We use probabilities. What we don't do, we didn't run a bunch of protection on a bullish moving stock. If you had earnings and had 1150 puts in place in April, we don't roll protection all the way up to 1645. You're taught level 1 basic principles. One of the principles of technical analysis is understanding a bullish moving stock and a bearish moving stock. If you kept rolling from 1150 to 1645 and went to that 1650, you had a stock that just moved $5 and you made less than $1 on it. The trend is your friend. If the trend is your friend, use level 1 education. In any education out there, this is the first thing they teach you. Stop putting bearish positions on bullish moving stocks. Stop rolling protection. Every time it gets up to another strike price, you are pissing away all of your profits. People that are just starting with me can see, hey, you know what? The stock is going up. And I think we first recommended it right here. It went up to 1260, back down, went up, back down, and then it took off. I mean, technically, you can say it was a triple bottom. But if the stock is moving up, it's moving bullish. Stop putting over and over and over again a bearish position so that you just gave away over 80% of your profits on a $5 move. That's over $4 you gave away by rolling a bearish position and having protection on all the time. That is stupid. We are not in 2008. If we go through the big crash that we're all expecting, then that makes sense. But it is stupid to have protection on all the time. Which brings me to my last thing for you, and I hope it's very easy to understand. Although I'm going to hate telling you this right now, right? Right now, Hurley Investments is not spelling properly at all, is not beating the S&P 500. We have added protection, insurance, and have not really needed it. Now, let me put this in simple, plain English. Do you ever go back to your homeowner's health insurance provider car insurance, life insurance, and asked for your money back if you didn't need it. They will laugh you out of their offices. Yes, I understand that right now we're not beating the S&P 500. We did fabulous last year. Unless you're in your first year, then we didn't do so fabulous. But the insurance protects you whether you need it or not. The positions we are in are great, undervalued, blue chip stocks. When people come back to work, I'm going to put it in September. When the reflation trade comes, when deflation rears its head, when, how am I going to say that one? When infrastructure stimulus kicks in, we will make it all up and then some, because we were protected and at times added shares. Last year, at the end of the year, accounts skyrocketed. At the beginning of the year, I made the comment, I think we're going to have the same thing happen this year. And it has, except we haven't had that big drop like we had February, March of last year. Kevin, what about deflation, right? Deflation is good because it lowers the price, the price of goods we make here in the US of A, which means people go out and buy crap. I'm calling it crap because that's what I do. Let me change that. That's not fair. Buy stuff at cheaper prices, which increases the GDP. Now, that doesn't necessarily help the stock market because companies are selling their goods at a cheaper price. So you're going to see some earnings misses, right? Not everyone can maintain their pricing power like Apple, like Disney, like Ford, like Under Armour, like Visa. I can't say the banks because we had the huge drop in the 10-year, which is actually hurting the banks right now. The problem with deflation is over time, companies make less, which hurts the stock market. And some people get worried and start saving. Which again brings me to my last quote. Why
when the stock market goes on sale, everyone rushes for the exit. What we do at Hurley Investments is we put protection on your portfolio so you don't have to run to the exit and be stampeded. Guess what? There are some times when we have purchased protection that you don't need. It's a process. You're going to be okay. You'll be really good down the road. But it is a process that it takes people time to orientate them through to understand what's happening and why. If you don't like the process, you are more than welcome to go anywhere else that you would like. But when you're going to someone that has to pick a stock for you, pick a mutual fund, the stock market is stacked against you and you're going to lose money because the probabilities are a 1 out of 3 chance of making money and a 2 out of 3 chance of losing money. It's just a matter of time before you're on that losing end. And you don't want to be on that losing end during retirement. The neat thing is if you have 2 positions in play that can make money going up or down, it changes the probabilities or the odds in your favor. You'll have a 67% chance of making money and a 33% chance of losing money. The key, it just takes some time. All right, guys, let's see here. Earnings dates are updated. Make sure you check that out. Where our market's heading this week, I really wanted to say up, but I'm choosing flat. I'm choosing flat because the 10-year yields have plummeted again, which means that money has to come into the stock market. But last time that happened, people freaked out. The bond market knows something the stock market doesn't, and our markets fell. I'm not sure where we're going this week. Really, today was an interesting day to watch things, but we did get protection on Baidu. Baidu does have protection. We waited through last week and the 2% drop, another 2% drop this morning being down $5, $6. We got our protection on. Dow Jones Industrial Average still bullish. S&P still bullish and overbought. NASDAQ, great job. Finished positive slightly today. Still bullish. S&P, I'm thinking will end July up 3%. Stimulus and earnings will move us forward. There are not many earnings this week. There are not many economic reports this week that will move us. The ISM non-manufacturing, which used to be called the services, came in today at a 60.1 instead of a 63.0. What does that mean? Let's put that into perspective, right? In fact, let me see if I have that. This week. Kevin, what does that mean? The ISM non-manufacturing index for June decreased to 60.1. The dividing line between expansion and contraction is a 50.0. The June reading marks the 13th straight month of growth for the services sector. But there's some key factors. New orders slipped. Production fell. Prices fell. Employment dropped, which is a good thing, right? Suppliers' deliveries decreased. Back orders rose. Plain and simply, the big picture, the takeaway from the report is they understand that the services sector activity is still running at a fast pace, although it had been moderated since May, with some of the slowdown driven by services companies experiencing difficulty with employee turnover and finding qualified candidates. What's happening? For those in the services industry like me,
I really can't hire someone that can sit on their butt and do nothing and make 60 grand a year. That is our problem right now. We have people that can make, in some states, 60 grand. Other states, it's down to 48, but they can make that yearly income until September. The writing was on the wall. We talked about this months ago. Small businesses have been hit by COVID and being forced to shut their doors by the government, which, again, not a bad thing per se. Some states that didn't follow those recommendations have done much better than others, but I don't know if the risk was too great, right? Not an employer's job to force someone to come to work in a pandemic. With that said, the government is now exacerbating the problem by running an extra 6 months of unemployment, still getting an extra 600 in some places to 300 in others on top of their unemployment. And they're going to start getting their 2021 child tax credits getting paid to them the beginning of this month. So for the next 6 months, we're prorating people's taxes to not have to go out and work as they receive some child tax credits. If you listened to me last year, you probably heard me sound exasperated. It's never a good thing when the government steps into your life. I'm not saying you lose freedoms and we're I don't know, what am I trying to say here? I'm not trying to create conspiracy theories and put you against the United States government, right? All I'm saying is that when the government steps in and mandates a way for you to live your life and takes away your choice, it's awfully difficult for capitalism to work. It's awfully difficult for small businesses right now to find the employees that will work. And we're in a generational change right now that, for crying out loud, it just seems to me this will be the first generation that doesn't do as well as the previous. All right. I've got some interesting stuff. Apple shares underperformed NASDAQ returns for first half of 2021. This is a video. There's a 180 price target on Apple. Kush Sankar, I don't know how to say the name. Senior analyst at Cohen. Click on the link. Please watch the video. Warren Buffett says the pandemic has an extremely uneven impact. It's not over yet. I agree. Make sure you enjoy reading this article. I found it very interesting, kind of calling, I don't want to say calling the kettle black, but helping people understand we have to muddle through the problems that COVID has given us. Stock should add to gains, and I think I may have shown this before. Stock should add to gains in the second half. This one came out a little after last Monday's commentary. Do pay attention to it. Wells Fargo says financials just a major turning point as dividends increased. Again, click on the link. This is one more video. This is helping me understand what it means when all 23 major banks get to increase their dividends because they passed their stress tests with flying colors. Do take some time to go over this. And this was forwarded to me. I don't know if they want me to mention it or not. But for the Bitcoin people, just take this with a grain of salt. just take a look at what's happening when the UK is starting to regulate a cryptocurrency. Pay attention to what happens as a company, a currency, a transactional form of exchange is going to be regulated. I think you'll find it pretty interesting. With that said, questions. What questions do you guys have that I can answer for you on this after the 4th of July and the market was closed weekend? With that said, while you guys are typing your questions, I am going to do a quick look because in the economic calendar, I want the whole calendar. Why am I not finding it? Economic calendar? This week. Over the weekend, we had what? Some of the G20 or G7 all stay together. And it was funny because 130 countries think that a 15% minimum tax on companies is a good idea. And boy, if you listen to Kevin O'Leary, he was hilarious this morning, just saying, you know, saying it and getting it done are completely separate things. And there's not a chance, and you know what, that it's going to get done. There's not a chance that we're going to get this world united 15% on global on a global tax for companies that are in their country. And it's easy to say, you know, Ireland has proven that, hey, to get a company like Apple, quite honestly, arguably the most profitable company ever, to create a headquarters in their country just for tax reasons. Countries have learned that this is a weapon to use to entice companies to work in your country, to employ your citizens, and even if they don't pay a 15% tax, all those hundreds or thousands or tens of thousands of employees will pay tax. The companies will pay some amount of tax, which is better than not having that company there at all. I don't understand how economics, okay, let me take that back. I don't understand how basic economics has become so hard for politicians to understand. It to a certain degree seems like common sense. So for the person there, I think that was William that asked a question about the global tax. Yes, that's what's happening. Russ, why do you think there's deflation coming versus inflation, right? I think there's deflation coming for probably two main reasons. Number one, I haven't quite seen the summer. I haven't seen the airline numbers. I haven't seen the tourism numbers take off like I would have expected to for a summer where we're mostly COVID free and people can travel, which means companies have been lowering their prices on their hotels, on their travel rates, on companies that expected more tourism to come through and they're not getting it, so they got to sell their inventory. And I'm making those comments 100% based on the tourism numbers, the the numbers of flights, and just looking at how the Olympics are going to be run in Tokyo, stay at home, watch from your TV. I mean, let's face it, the United States is in a much better position worldwide because we have 400 million vaccines that people can get vaccinated if they so chose. There are some countries that don't have that option to vaccinate their people yet. Kudos for the United States in sharing some of the vaccines, but let's do the numbers again. 8.6 billion people in the world, we're 400 million. That's 8.2 billion people. China has a vaccine that we're not sure if it helps them or kills them right now. That leaves 8.2 billion people still dealing with COVID. Oh, so we donated 100 million vaccines. That leaves 8.1 billion people still dealing with COVID. Oh, but 500 million people got COVID already. That leaves 7.6 billion people still dealing with COVID. We have some problems. We have some problems, and the reopening trade hasn't gone off in the United States because we have government paying people to stay at home and not work. We're overpaying unskilled labor. The opening or reopening or reflation, not the reopening worldwide is probably still a year away. I don't understand why Disney hasn't taken off. Disney has done everything right. And their valuation for their streaming that's creating billions of dollars of revenue for them and their movies, there's no credit there yet. Does that mean that we actually really quickly, let's do a sound check. Can you guys hear me? You guys able to hear me? And are we back? We're back. All right. Sorry about that. Looks like I've lost a little bit of sound on my side. Disney's cash cow and what's really building their growth into the future is being over because, all right, hold on. Stay off the internet, please. Might be my internet. All I'm going to say, and we'll finish up here, is that Disney's growth is being overshadowed by their core business holdings. And that's what's holding Disney back right now. It's a great opportunity. We're getting it at a discount of 15%. It'll catch up. Any other questions you guys have? If not, let's call it a night. Let's call it a night. I appreciate you guys being. Hopefully this was helpful to you. Hopefully this was some good information. Good. Okay, I'm going to get this posted tonight. Guys, have a great, hopefully you had a great 4th of July or a great weekend having the market closed. ADP, hopefully you celebrated in Brazil, Abraham, our holiday. I'll get this posted as quickly as I can. And guys, look forward to talking to you next Monday. Key will take care of the commentary this Thursday. Talk to you later. Bye-bye.